Hello and welcome to the Quality Mortgage Services YouTube channel. Today is October 29th and I'm going to cover 4 topic areas in the regulatory area of our industry. One is I'm going to read some information regarding the CFPB's finalizing points of the fee cure, so that's a big topic right now. Federal regulators finalize risk retention rules. Ginnie Mae announces increase in capital and liquidity requirements, and also the federal regulatory request feedback on the proposed flood rules. So we're going to discuss all 4 of those real quick, and just bear with me as we get through this. Starting with the CFPB finalizes points and fee cure. The CFPB has issued a final rule establishing the cure mechanism under the ability to repay or qualified mortgage, known as ATR or QM rule, which will become effective as soon as the rule is published in the Federal Register. Under these new provisions, a creditor or assignee of a mortgage loan may correct points and fees overages that would disqualify the mortgage from meeting the QM requirements, providing that the mortgage meets the other QM requirements and certain other conditions are met. These include that the creditor or assignee, 1, provides a refund of the excess to the consumer within 210 days. So it's 210 days after consummation. 2, follows policies and procedures for post-consummation reviews of points and fees and making the cure payments. And 3, pays to the consumer interest on the dollar amount by which the points and fees exceed the QM limits for the period from consummation until the cure payment is made to the consumer. Notably, the rule cuts off the ability to cure if the consumer A, institutes a legal action in connection with the loan, B, provides written notice to the creditor, assignee, or servicer that the loan's points and fees exceed the QM limits, C, the consumer becomes 60 days past due on the mortgage. Otherwise, the rule provides that the lender or assignee may cure the loan up to 210 days after consummation, not for 120 days as originally proposed. This is a huge victory for the industry, and also drops the requirements that the loan must be originated in good faith. The final rule also attempts from ability to repay requirements of nonprofit creditors that originate certain interest-free loans, contingent subordinate liens, and extends the small servicer exemption to include nonprofit entities that service 5,000 or fewer mortgages. I guess that's a year. The notice of the rule indicates the CFPB will still consider comments submitted on the potential cure or correction process of debt-to-income issues. And importantly, the rule sunsets on January 10th, 2021. Wow, I think that's a huge victory. Thank you for all the people with the Mortgage Bankers Association and Advocacy and MORPAC that went out after this to get this. That's a great victory. Thank you so much for, and not only them, but anybody else that participated. The next one is federal regulators finalize risk retention rules. A mouthful. All right. Last week, the federal regulators began voting to finalize the risk retention rule mandated under the Dodd-Frank Act. The Federal Reserve, the OCC, the FDIC, Security Exchange Commission, and the Housing and Urban Development, collectively, the regulators were charged with jointly developing a rule to require issuers of asset-backed securities to retain a portion of credit risk associated with the securitization. Securities backed by high quality collateral, such as qualified residential mortgages, are exempt. That's awesome. So again, success in the QM rule. So let's talk about real quick, the Ginnie Mae announces increase in capital and liquidity requirements. Ginnie Mae announced Increases in its capital and liquidity requirements. The fixed portion of the required capital remains the same as $2.5 million, but the variable portion of the capital requirements will increase from 20 basis points to 35 basis points of the issuer's total effective outstanding single-family obligation. The liquidity standards will change to 10 basis points of outstanding single-family securities subject to the floor of $1 million. Presently, the liquidity standards is 20% of the capital net worth requirements. Further, issuers who are approved to participate in more than one program type, single-family, multifamily, manufactured homes, and or home equity conversion mortgages, which is the FHA reverse mortgage program, mortgage-backed securities, will have to meet each minimum adjustment net worth and liquidity requirements equal to or greater than the sum of the minimum requirements for all of the program types in which the issuer is approved to participate. These requirements will be applicable to new applicants commencing January 1, 2015. Issuers approved on or before December 31st, 2014 will be required to meet the new requirements beginning December 31st, 2015. Okay, let's talk about flood. Federal regulators request feedback, so they're requesting feedback on a proposed flood rule. And the NBA has submitted its comments, and we're going to learn a little bit more about what's involved in this. So on Friday, 5 regulators, the Federal Reserve, the FCA, FDIC, NCUA, and OCC, released a joint notice of proposed rulemaking to amend the flood insurance regulations for loans secured by property located in special flood hazard areas. The press release notes that the proposed rule would implement provisions of the Homeowners Flood Insurance Affordability Act of 2014 relating to escrowing flood insurance payments and the exemption of certain detached structures from the mandatory flood insurance purchase requirement. The Act amends the escrow provision of the Biggert Waters Flood Insurance Reform Act of 2012. In accordance with HFIAA, the proposed rule would require regulated lending institutions to escrow premiums and fees for flood insurance for loans secured by residential real estate and mobile homes that are made, increased, extended, and renewed on or after January 1, 2016, unless the regulated lending institution or a loan qualifies for a statutory exemption. In addition, the proposed rule requires institutions who provide borrowers of residential loans outstanding January 1, 2016, the option to escrow flood insurance premiums and fees. The proposal includes new and revised sample notice forms and clauses concerning the escrow requirements and the options to escrow. Finally, the proposal would eliminate the requirement to purchase flood insurance for a structure that is a part of the residential property located in special flood hazard area if that structure is detached from the primary residence structure and does not also serve as a residence. Would you get all that? However, under HFIAA, lenders may nevertheless require flood insurance on the detached structure to protect the collateral securing the mortgage. So there's going to be other rulemaking periods regarding this, but I think it's pretty interesting that you have special flood zones and they're trying to figure out ways to get payment because people don't want to pay, but yet the lenders can't make them pay. That's so interesting. So anyway, hey, first of all, congratulations to all the people who are active in this process and the rulemaking and developing and adding some comments and opinions and I guess wargaming strategies on how this could affect not only the industry but the consumer and also the mortgage banks and servicers out there. We really appreciate all the hard work you're doing, especially the Mortgage Bankers Association, who has brought all these people together and other organizations as well. So thank you very much, and we appreciate it. Have a great day.